Whenever experts discuss the prospect of an AI bubble being prone to imminent bursting, one of the key details that very often gets glossed over is who gets to foot the bill of such collapse. Common sense would imply that the mega corporations and hyperscalers responsible for the trillions of dollars worth of credit used in the aggressive build-out of AI infrastructures such as data centers should be the ones who almost isolatedly bear the costs of such collapse. However, everyday people who almost certainly have no interest in AI, or at least have no involvement in the seemingly reckless spending that has been going into the debacle, will be left with a Miami Club-sized bill, should it all unwind, in form of a significant drop in their 401ks and retirement portfolios. Now, let's break down how this all happens. NVIDIA has just lined up more than $500 billion in funding to finance further AI build-outs. Six major financial firms, BlackRock, Blackstone, Brookfield, Apollo, KKR, and Goldman Sachs, have signed on to one of the largest financing packages the AI industry has ever put together. And on the day this was announced, NVIDIA's stock fell roughly 2.6%, wiping around $130 billion of its market value. You'd think securing more than $500 billion to fund the biggest technological build-out in decades would be overwhelmingly bullish, but the market didn't see it that way. And that's because this announcement wasn't really about growth. It was about credit. For the last 2 years, the AI trade has been rewarded every time these companies increased their spending. But increasingly, the question has shifted from how much they're spending to who is actually paying for it. Combined hyperscaler capex for 2026 is estimated somewhere between $680 billion and $800 billion and approaching $1 trillion next year. That's a roughly 67 to 81% growth in a single year, and obviously, that's an extraordinary amount of capital. But spending isn't necessarily the problem. The problem is what that spending is doing to cash flows. Amazon recently spent around $54.2 billion on capital expenditure while generating a negative $8.8 billion in a free cash flow. Alphabet spent $44.9 billion and generated a negative $5.4 billion, its first negative free cash flow quarter as a public company. Meta spent more than $30 billion and was left with only $1.7 billion in positive free cash flow. Oracle spent $16.5 billion and generated negative $1.9 billion. Microsoft, however, remains the major exception, spending roughly $35.8 billion while still generating $19.6 billion in free cash flow. The broader trend, however, is obvious. PIMCO estimates that capital expenditure is now consuming around 94% of hyperscaler operating cash flow, compared with less than half just 2 years ago. So the cash machines are increasingly consuming cash rather than generating it. And that raises the obvious question. If profits aren't covering the AI bill, who is? Well, increasingly, the bond market. Tech and adjacent companies issued roughly $225 billion of bonds during the first half of the year, and hyperscaler-specific issuance reportedly went up from just about $16.7 billion in 2024 to around $193 billion by mid-2026. That's more than a tenfold increase, and this could be just the beginning. Morgan Stanley and JP Morgan estimate that roughly $1.5 trillion of additional technology and data center debt could be required through 2028. Goldman's credit team estimates that more than a third of this year's AI infrastructure spending is already being funded through debt. And when you look at individual companies, the leverage becomes even clearer. Alphabet issued around $21.1 billion in net debt last quarter. Meta issued about $25.9 billion. Amazon issued around $10.2 billion, with its long-term debt now above $119 billion after rising around 81%. Oracle is carrying approximately $156 billion in total debt while generating negative free cash flow. And S&P recently downgraded Oracle from a BBB to BBB-, leaving it just one notch above junk. S&P also noted that nearly half of Oracle's roughly $638 billion in remaining performance obligations are tied to a single customer, OpenAI. But even these numbers don't tell the full story, because there's another mountain of obligations sitting outside the traditional balance sheet. Moody's estimates that data center lease commitments across six major players amount to roughly $1.2 trillion. More than $820 billion of that is connected to facilities that haven't even been built. Morgan Stanley's own estimate puts total off-balance sheet commitments around $1.8 trillion, including purchase commitments, leases, and financing arrangements. Meta alone reportedly has around $279 billion in future AI data center lease agreements. So when you look at the AI build-out, you can't simply look at corporate debt and call it a day. There are enormous commitments hiding in leases, purchase agreements, and financing structures, and this brings us to one of the more controversial parts of the entire AI boom: circular financing. The Bank for International Settlements has reportedly identified circular AI financing as one of the major risks to global financial stability. It is worth noting, however, that the structures being used today are more sophisticated than what we saw during previous bubbles. The risk can be pushed into special purpose vehicles, private credit funds, and lease-backed financing rather than sitting directly on NVIDIA's balance sheet. Jensen Huang has suggested that NVIDIA could potentially backstop up to 25% of the financing, or around $125 billion. But this creates another problem. The assets being financed are GPUs, and GPUs don't behave like railroads. They become obsolete and fast. Some estimates put the competitive life of certain AI chips at only 2 to 3 years, while the debt financing them can last 5, 10, 20 years or even more. You're essentially financing hardware that depreciates like a laptop, with debt structured more like it's financing a bridge. And that's a potentially dangerous mismatch. Michael Burry has argued that 5 and 6 year depreciation schedules may understate the real economic depreciation of AI chips by around $176 billion between 2026 and 2028. However, NVIDIA disputes this, arguing that GPUs can remain useful as they move from training into inference and enterprise applications. Maybe they're right. But the fundamental question remains, will the revenue arrive before the debt needs to be paid? And there are already signs that credit markets are becoming less enthusiastic. NVIDIA's 5-year credit default swaps, effectively the market's price for insuring against default, reportedly doubled over a 2-month period. At the same time, demand for corporate bonds has weakened. In February of 2026, investors were putting in almost $5 of orders for every $1 of bonds being offered. By July, that had fallen to less than $2. And now imagine adding another $1.5 trillion of AI-related debt into that market over the next 3 years. That money doesn't come from an AI-only pool. AI companies are competing for the same capital as utilities, manufacturers, mid-sized businesses, real estate companies, and everybody else that needs financing. And that's where this starts becoming a problem for people who don't own AI stocks, because you probably own them anyway, just indirectly. The Magnificent Seven, who are very heavily exposed to the AI bubble, represents roughly about 34% of the entire S&P 500, and the top 10 combined companies represent around 38%. So, if AI experiences a major repricing, your pension, workplace retirement fund, or index fund can be affected even if you've never bought NVIDIA. And it's not just equities. Technology now makes up roughly 10% of Bloomberg's corporate bond index. Then there's interest rates. The 10-year Treasury is around 4.72%, while the 30-year sits around 5.25%. Massive corporate borrowing can increase demand for capital, forcing companies to offer higher yields to attract investors. And if AI companies absorb more of that capital, everyone else competes for what's left. That's how an AI investment boom can eventually become an economy-wide financing problem. And increasingly, some of that risk is moving into private credit. Banks have limits on how much exposure they can take to individual borrowers, so more AI financing is being absorbed by private credit funds. BIS data shows private credit lending to AI and cloud companies rising from around 3 billion in originations in 2010 to more than $40 billion in 2025. Total exposure is now reportedly above $200 billion, with projections of $300 to $600 billion by 2030. Morgan Stanley sees an $800 billion private credit opportunity in data center financing through 2028. CoreWeave, meanwhile, has reportedly pledged GPUs as collaterals against billions of dollars in loans. And this is where history becomes particularly useful, because we've seen this movie before. During the late 1990s telecom boom, companies like Lucent and Nortel helped finance customers so those customers could buy their equipment. The vendors booked the sales, the customers built enormous networks, and then the customers failed. Lucent's market capitalization collapsed from a peak of about $258 billion. Across the broader fiber build-out, more than 90% of telecom high-yield debt was eventually defaulted on or restructured, while much of the fiber that had been installed was barely used. But here's the interesting part. The internet wasn't fake. The demand thesis was eventually correct. The problem was that the infrastructure had been built too early, too quickly, and financed with debts that matured much sooner than the economic returns arrived. And this wasn't unique to telecom. Go back even further and look at the railroad boom. Investors poured enormous amounts of money into railway construction because they understood that railroads were going to transform the economy. They were right, but the speculation, overbuilding, and excessive leverage eventually contributed to the major financial failures, including the Panic of 1873. Railroad companies collapsed. Banks failed. Investors were wiped out, and yet decades later, railroads became some of the most economically important infrastructure in the modern world. The technology was right. The long-term thesis was right. The financing and timing, however, were wrong. And this is where AI could actually be worse. A railroad track can remain useful for decades. A fiber can remain part of the infrastructure stack for decades. But GPUs can lose their competitive advantage in just a few years. So if you finance a GPU with debt that lasts 10 or 20 years, your collateral can become obsolete long before the loan matures. The AI industry, therefore, doesn't simply have to prove that these data centers will eventually become useful. It has to prove that they will generate enough economic value quickly enough to service the debts attached to rapidly depreciating hardware. And that brings us to the fundamental transformation of the AI trade. 2 years ago, the AI build-out was largely financed by profits. Big tech companies generated enormous amounts of cash and reinvested that cash into building more infrastructure. Today, an increasingly large portion is being financed through corporate bonds, private credit, leases, purchase commitments, and increasingly complicated financing structures. That's a fundamentally different bet. Because the question is no longer simply, will AI become economically important? The question is, will AI become economically important quickly enough? If the answer is yes, then all of this leverage could remain invisible. The data centers get filled, the GPUs generate revenues, the debt gets serviced, and everyone involved end up looking like geniuses. But if AI revenues arrive 3 or 5 years late, somebody still has to make those payments. And increasingly, that somebody isn't just NVIDIA or the banks. It's bond investors, private credit funds, pension funds, and insurance companies. Which means the AI boom can be completely real, the technology can be genuinely transformative, and the infrastructure can eventually become enormously valuable, while the financial system financing it can still suffer a massive blow-up along the way. Because history has shown us that the most dangerous part of an infrastructure boom isn't necessarily being wrong about the future. Sometimes it's simply being too early. And unfortunately, the bills for being too early and a potential bubble burst appear to be getting prepared to be served to your retirement accounts. If you enjoyed this video, do well to give it a thumbs up, subscribe to the channel, and turn on post notifications so you do not miss further insightful videos like this.